Imagine you've got some extra pocket money. Naturally, you might just keep it safely tucked away in a piggy bank at home. I mean, it's secure, sure, but here's the problem. While it's just sitting there idle, it isn't earning you a single dime of interest. And even more importantly, it isn't helping a local farmer buy seeds or a small factory purchase new machinery. That right there is the fundamental challenge of modern economics. And it brings us to the topic of today's explainer, commercial banks. They are literally the financial heartbeat of the economy, pumping resources exactly where they're needed most.
So, here's our game plan for today. We'll start by tackling the piggy bank problem, explore why commercial banks actually matter, and then break down the two main steps, accepting deposits and advancing loans. Finally, we'll wrap up with my favorite part, the absolute magic of credit creation.
All right, Section 1, the piggy bank problem.
It really all comes down to a simple equation. Idle money equals wasted economic potential. When thousands or millions of us hide surplus cash under our mattresses or in piggy banks, the economy essentially starves. Money has to move to be useful, right? There are always people with extra cash on hand, and on the flip side, there are always businesses or individuals who desperately need that cash to invest, build, and grow. So the economy needs a bridge to connect these two groups.
And, well, that bridge is the commercial bank. By definition, a commercial bank is a financial institution that accepts deposits from the public and gives out loans for consumption and investment. But hey, don't miss the most crucial part of that definition: to make a profit. This is super important to remember. Banks aren't charities. They're profit-seeking businesses that provide an absolutely essential public utility by taking money from where it's sitting idle and moving it to where it can be put to work.
Moving on to Section 2, why commercial banks matter. There are 4 really foundational reasons why these institutions are essential in a modern society. First up, mobilization of savings. They encourage people to save and then collect all those small, scattered amounts into massive pools of funds. Second is capital formation. By offering attractive interest rates, banks encourage thrift, which turns those everyday savings into real capital for investors. Third, they provide credit. This is the lifeblood of trade and industry. And fourth, economic development. They specifically direct funds to priority sectors, think agriculture and small-scale industries, which really drives a country's overall growth.
Ultimately, the banking system is the chief source of credit in an economy. By juggling two things at once, keeping depositors' money perfectly safe while simultaneously advancing loans to those who need it, they become an absolutely vital institution. Without them, commerce would literally just grind to a halt.
Okay, Section 3. Step 1. Accepting deposits.
Now, banks purposely tailor their deposit accounts to fit different needs. On one side, you've got the savings account. This one is designed for you and me, households, salaried employees. It earns a nominal or, relatively low rate of interest, and there are some limits on how often you can withdraw your money. But on the other hand, we have the current account. This is strictly for businesses. There's zero interest paid on this money, but a business owner can make an unlimited number of transactions every single day just to keep their fast-paced operations running smoothly. And we can contrast that high-speed liquidity with fixed deposits. So while current deposits can be withdrawn anytime without any notice, if you have surplus money that you know for a fact you won't need for a while, you can lock it into a fixed deposit, sometimes called a time deposit, because you're giving the bank a guarantee that they can hold on to that money for a fixed period, say anywhere from 7 days up to 10 years. They reward you at their highest rate of interest. Basically, the longer you lock it away, the higher the rate you get.
Which brings us to Section 4. Step 2. Advancing loans.
Before we look at exactly how they lend, we need to understand why. Remember earlier when we said banks are out to make a profit? Well, here's their fundamental business model. The bank pays you a lower interest rate on your savings. Let's call that the borrowing rate. Then they turn around and lend your money to someone else at a much higher interest rate, the lending rate. The spread, or the difference between those two rates, is the bank's primary source of income. It's how they make their money.
But banks don't just hand out stacks of cash in one single way. They offer a bunch of different facilities to meet different needs. This includes things like cash credit, demand loans that can be recalled by the bank at any time, short-term personal loans, and overdraft facilities, which actually allow a current account holder to withdraw more money than they even have in their account, up to a pre-agreed limit.
Just to highlight the nuances here, think about the difference between cash credit and an outright loan. With an outright, or short-term loan, the bank deposits a lump sum directly into your account, and you immediately start paying interest on that entire amount from day one, whether you've actually spent it yet or not. But with cash credit, the bank just sets a limit. Say you have a limit of $100,000, but you only withdraw $20,000 to pay suppliers. You only pay interest on the $20,000 you actually used. It's way more flexible for a business trying to manage its day-to-day working capital.
All right, Section 5, the magic of credit creation.
So everything we've talked about so far sounds like simple matchmaking, right? Taking from one, giving to another. But it is so much more than that. When a commercial bank grants a loan, it doesn't just hand over physical cash it had sitting in a dusty vault. It literally opens a deposit account in the borrower's name and credits it with the loan amount. By doing this, the bank is actually generating new money in the economy's money supply. That's exactly why commercial banks are formally known as the creators of money.
Let me show you exactly how that magic trick works. Imagine a depositor walks in with 1,000 rupees. The bank accepts it, but the bank knows from years of experience that not everyone withdraws their money at the exact same time. So they keep a cash reserve, let's say 20% in this example, which is 200 rupees, safely in the vault. That leaves 800 rupees. The bank then lends that 800 rupees out to a new borrower. Suddenly, the original depositor still has a balance of 1,000, and a brand new borrower now has $800. The money supply just expanded out of nowhere.
Let's break that down sequentially, step by step. Step 1. The bank accepts the initial cash, which we call a primary deposit. Step 2. They hold back a mandatory percentage as a cash reserve. Step 3. They lend out the rest. Now, here is the kicker. Step 4. The person who took the loan spends it, say, to buy a new machine for their business. The person who sold that machine gets the cash and deposits it right back into the banking system. This creates a secondary deposit, and the entire loop starts all over again.
This whole process creates a continuous cascading effect. Round 1 starts with that $1,000 deposit. 800 is loaned out. In round 2, that 800 comes back as a new deposit. The bank keeps 20% of that, which is 160, and lends out the remaining 640. In round 3, the 640 gets deposited, 128 is held in reserve, and 512 is loaned out. This process repeats continuously, creating secondary deposit after secondary deposit, getting smaller each time, until the lending capacity finally reaches 0.
So how much total money actually gets created from all this? We figure that out using a really simple formula called the money multiplier. It's just 1 divided by the reserve requirement. Since our reserve was 20%, or 0.2, 1 divided by 0.2 equals 5. This means that initial 1,000 rupees deposit will multiply 5 times throughout the banking system, ultimately generating a massive 5,000 rupees in total deposits. That is the incredible exponential power of credit creation fueling economic growth. If we zoom out for a second, you can really appreciate the sheer scale of what banks do. Beyond all the primary functions we just covered, banks offer a vast web of utility. They perform agency functions, like transferring your funds from place to place, paying your insurance premiums, or buying and selling securities on your behalf. They also provide general utility functions, like offering safe deposit lockers for your valuables, dealing in foreign exchange, and underwriting government securities. They truly are the central nervous system of modern commerce. Which leaves us with a fascinating and maybe slightly unnerving thought to ponder. We've seen how banks multiply money and keep the economy alive by circulating our surplus cash. But if banks are the creators of money solely through this really delicate chain of continuous deposits and loans, what happens if everyone, everywhere, decides to stop depositing their savings tomorrow and goes back to stuffing cash in piggy banks? Think about how quickly that heartbeat would stop. Thanks for joining me on this explainer, and I hope you never look at your savings account the same way again.